There are a couple more qualitative factors to consider when making a decision whether or not it's best for you to rent or own your home. I'm going to go through those quickly, and then we're going to go through some market scenarios to get a better understanding of what's right for you. So the first thing to consider is your own personal financial situation. Can you afford the upfront costs of buying a home, which is putting away a down payment and making a monthly mortgage payment? Do you have a stable enough income to cover your mortgage payments, property taxes, maintenance, and insurance, your TMI? The next is your long-term plans. And this will also help you determine what type of mortgage product is best for you. And we have a mortgage guide available that covers everything you need to know, from terms to open versus closed to fixed versus variable. How long do you plan to stay in the area? How long do you plan to stay in the asset? Will you need the liquidity from the house? Do you plan to move frequently? Does your job depend on you being in a certain place? If you need to be more agile or mobile, then renting might actually be a more practical option. But if you can afford to be stuck in one place for a long period of time, then ownership could be a good wealth building tool for you. The last piece I want to think about is market conditions. Are home prices rising or falling in your area? You might remember I mentioned that time in the market is a lot more important than timing the market. So this timing can affect the potential for appreciation in the short term for your property. But over a long enough timeline, assets typically do tend to appreciate in value. That or the buying power of a dollar tends to come down. And so you can usually account for a property being a net positive investment by the time you've amortized your mortgage. Now we're going to go over some market scenarios to get a better sense of understanding of whether or not it's better for you to rent or buy your home. As mentioned earlier, the whole thing really depends on whether or not you as an individual are good at investing your money outside of owning your primary residence. So in scenario one, we're going to look at if you're good at investing, and that would mean that you could earn, let's say, a 10% ROI or return on investment outside of real estate opportunity costs. If you don't know what an ROI is, then you might fall into category number two, which is you're probably not good at investing. And that's okay. That's why I like buying my primary residence as well. In scenario two, we would assume that you could put your money in a very safe, almost risk-free asset class and earn a 5% per year ROI or return on investment. So we're going to start this analysis by looking at home buying costs that could otherwise be invested in something else. And that's where we'll apply that 10 or 5% annual return that you could make on that money. That's your opportunity cost. So the first one is a down payment. This is the initial payment made towards the purchase of a home, typically the percentage of a property's purchase price. So it's not a sunk cost. It's just tied up. You can't touch that money until you either sell the house or take equity out of the property through a refinance. If the purchase price of your home is $500,000 or less, the minimum amount of down payment is 5% of your purchase price. If the purchase is between $500,000 and $1 million, then the minimum amount of down payment is the 5% on the first $500,000 of the purchase price and 10% of the purchase price over $500,000. And if the price exceeds $1 million, then expect to pay a minimum of 20% down on that property. The next cost associated with purchasing your house is closing costs. These are fees associated with the purchase of a home, including mortgage registration fees, title insurance, which all lenders will require, and appraisal fees, as well as land transfer taxes. Closing costs in total can typically range from 1.5 to 4% of the purchase price of a home. We would usually recommend that you forecast on the higher end of that so that you don't show up with a nasty surprise on closing day when you're looking at the statement of adjustments with the lawyer and realizing that you don't have enough money to close this property. We're going to cover in detail all of those things I just mentioned and what they are later in this course. So don't be concerned if you don't know what a statement of adjustments is yet. The next piece on the list of costs are home repairs and maintenance. These are ongoing repairs, maintenance, and upgrades, which are typically the responsibility of you, the homeowner. The average homeowner spends over $12,000 per year alone on home repairs and maintenance. And all of this money is money that you couldn't not invest in something else to make you money. This is a sunk cost. It's money you'll never see again. The next piece, as we mentioned earlier, is property taxes. These are taxes to be paid to the local government based on the assessed value of the property. As we mentioned before, it varies between cities, but you could estimate to pay anywhere from $5,000 to $10,000 per year in property tax. So another cost that we also mentioned earlier in the course is the fees that you have to pay to a condominium corporation. On average, they would cost about $0.58 per square foot, or 58 cents per square foot. So we could estimate that these, for a condo owner, could be around $400 to $600. Next, we have home insurance. This is insurance coverage for the property. As mentioned earlier, is about $1,000 to $3,000. So we'll use a number of $2,000 for this cost estimate here to determine whether or not buying or renting makes more sense depending on how good of an investor you are. The last piece I want to look at here is mortgage interest. So over the life of a mortgage, the interest paid can be a substantial sunk cost. Here's a quick visual of how much interest you might end up paying. Assuming we're borrowing $800,000. So you're buying, let's say, $1 million home with a 20% down payment, and you're going to use a 30-year amortization at a 5.5% interest rate, which is a relatively standard interest rate over the history of Canada. Over the first 5 years of your mortgage, so over the first mortgage term, typically your mortgages are a 5-year term, you would pay over $200,000 in interest alone on that $800,000 mortgage. So that's $200,000 that you otherwise could have invested in something else were you renting rather than owning your home. On top of that, you have utilities and other monthly costs. So things like internet, electricity, gas, etc. But these are costs that you would also accrue if you were renting. So we're going to leave those out. On all of these sunk costs, on all of the costs that are burning money that you're never going to see that money again, we have something called an opportunity cost. And that's the potential return on investment that could have been earned from investing that down payment and all of those sunk costs in something else. So let's say that all of those costs, that $200,000 down payment, that $200,000 of interest that you paid over the first 5-year term, and all of your maintenance fees add up to, let's say, $500,000 for ease of math. And during that period of time, you invested that at a 10% annualized return. Even without compounding, that's $50,000 per year that you could have made on the cash that you've invested in costs that are otherwise sunk because you chose to own a home. This would mean that your home would need to appreciate at about 5% per year to make it worth your while to own the home rather than invest that money in something else, assuming you can make a 10% rate of return, which is not easy for most people. If you remember what I said at the beginning of this course, most Canadians choose to put a lot of capital into their primary residence because they're not good at saving and they're not good at investing. And I'm one of those people. It would be difficult for me to achieve a 10% relatively risk-free return. And so that's why I choose to put more and more capital into a house than into the stock market. Most Canadians would fall into this category. So you need your house to go up in value 5% per year to make it make sense. This is likely achievable based on the history of house prices in Canada. Since the data set originated, Canadian home prices have grown at about 4.11%, whereas house prices in the province of Ontario have grown at about 6.11% since the bottom of the last real estate cycle, which took place in the 1990s. And so I think it would be reasonable to expect that your house could technically grow somewhere between those two data points at around 5%. And so this is why, adjusting for a couple of discrepancies, most Canadians choose to invest most of their capital in a primary residence rather than rent a home and put it into alternative investments. The next piece we want to touch on here is whether or not there is a good time to buy or sell a house. If you check your fancy realtor notebook, you'll note that the industry is famous for saying it's always a good time to buy and sell real estate. But is it, or are there optimal times? Real estate prices behave in a seasonal fashion. And if you look at the average and median price, they follow a particularly predictable trend. Average prices rise in the spring. This is called your spring market. And this is when a lot of people typically want to sell. There are some skews in the data that would cause this phenomenon to take place. The biggest one being that Families who purchase bigger homes typically want to move in the summer between school year, and they would buy in the spring to have a closing in the summer. And they're typically the ones buying bigger homes, which would skew the average up. After the spring market has taken place, usually in about May, prices and volume will typically fall from May until about August. Prices and volume rise again in the fall when buyers are active again during the school year, making those considerations and trying to move towards the end of the year. In the winter, because of the holiday season, prices and volume typically flatline or fall off again, heading into December and January, and then they pick back up again for the spring market of the next year. So it's relatively easy to read seasonal graphs and how the seasonally adjusted averages work. Typically, the seasonal pattern in Canada is that spring and summer are high demand seasons and higher competition among buyers with more listings, while the winter is the opposite. Interest rates are obviously one of the driving forces, as low interest typically mean attractive time to buy, as mortgage payments will be lower, and this allows people a greater amount of buying power, which can drive prices up. And finally, market conditions and local factors play a big role and can allow certain areas to break seasonality. For example, cottage country might actually see a stronger summer market than a fall or spring market, or leasing markets or rental markets typically will follow the opposite of a seasonal pattern, where condo rentals, as an example, are often hotter leading into July, August, and September. House prices and the quality of real estate as an investment can also hit rough patches, as history has shown us. Think back to the 2008 housing market crash in the US, which is probably the most notable recent example that we have. And Canada actually didn't fare too poorly during that period of time. But if you go back even further, you can see pretty strong examples of a long-term cyclical behavior happening in Canadian real estate. And this is basically that house prices rise as interest rates get cheaper, and house prices tend to fall as interest rates go up. If that interest rate is left too low for too long, you can get something called a bubble forming, or you create risk that the market enters into bubble territory. One of the best indicators of this is whether or not the interest rate for your mortgages is higher or lower than the rate of inflation. And this is actually called a real interest rate. When something is real, it's been adjusted for inflation. And if you look back at the history of Canadian real estate, in periods where the real interest rate was negative, where people could borrow money at negative rates when adjusted for inflation, it tends to induce a little bit of irrational financial behavior. And it allows the market, especially the real estate market, which is heavily dependent on interest rates, to enter into a state of exuberance. If we look at the example that I just mentioned in the US, think back to that market crash. It was caused by a housing bubble burst and risky lending. It left millions of homes in foreclosure and wreaked havoc. Canada has had its own hiccup in 2017 when interest rates were forced to be pushed up by a market that was running a little bit too hot. During this period of time, stricter mortgage rules such as the B20 stress test, which we're going to cover later in this course, as well as something called the non-resident speculation tax, or NRST, were introduced in an effort to calm the housing market as it was getting into a bit of a state of mania. This basically made it harder for people to qualify for mortgages, reducing the buying power of domestic Canadians, and it also added a tax to non-Canadian purchasers, foreign investors, to reduce the demand coming from that side of the equation as well. Policies of this type took place in Vancouver in 2016 and Ontario in 2017. Vancouver, for example, saw home prices drop 7.7% in just a year during that period of time, and Ontario saw house prices drop between 20 and 30% in certain markets in 2017 after the non-resident speculation tax was introduced. Taking real estate investing seriously can save you from potential pitfalls like the ones we just described. So before diving in, do your homework, think about market trends, track them, look back and understand market cycles, as well as the different costs and risks associated with it, like the ones we just outlined, and go over ways that real estate might actually reduce your wealth in a extreme risk realization scenario. If you're comfortable with all these risks and you still want to buy a house, then it's probably the right decision for you to make. This is why we think about downside risk and the bear case when evaluating whether or not investment decision is the right one to make. Are you comfortable with the worst case scenario? If that's a box you can check yes to, then you're probably good to proceed. One of the other ways to think about real estate investment is whether or not you're doing it as an investment, which is buying an asset that produces a yield or a rate of return, or if you're doing it as a speculation. There's nothing inherently wrong with speculation. I'm not saying that as a term to criticize anybody, but there are ways to speculate in real estate that are more or less advantageous than others. If you're buying a property because it's going to go up in value and that's the only reason that you're doing it, that would be a speculation. If you're doing it not because it's producing rent, but because it's going to produce capital appreciation. And one of the ways that a lot of people like to do this without actually having to take possession of the asset is through the purchase of pre-construction. So there's two ways that you can buy real estate for capital appreciation in the Canadian market. The first one is direct investing. It's buying a house and owning that house, which we've mentioned and gone through exhaustively so far. And the next one is buying a pre-construction property. So this is purchasing the right to own a unit in the future. Pre-construction is a phase of the real estate development process that usually occurs before the actual construction of the property takes place. Usually a developer has to fulfill a amount of pre-sale requirements, typically 60 to 80%, in order to have their lender advance them funding for the construction of that project. And so they need future unit holders to express an interest and provide deposits for those properties in order to proceed with the project. So they technically think of these purchasers as almost partners in the project. By buying a pre-construction, you're often doing the developer a favor, and in that case, you might actually get a bit of a discounted price. And you don't have to close on the unit until the project is complete. So for a low-rise or single-family detached home, this might take 2 years. But for a high-rise project where they have to build an entire skyscraper, it can take up to 6 years. And a lot of pre-construction investors bank on the market appreciation that will take place during that period of time, and they try and pay a price closer to today's price when they commit to buying the unit today and hope that it appreciates in value by the time they have to close on it in 6 years' time. You're essentially making a bet that the market's going to go up, and you're rewarded for being early. And you don't actually have to take possession of a unit in order to realize the benefits if your investment decision is correct. This is compelling for a lot of people because it means you don't have to manage a unit, you don't have to put an entire down payment on a unit, and you don't have to take out a mortgage on a unit. So let's examine the down payment piece a little bit. When you buy a home, like the example we used before, you're usually going to put 20% down. Anything less than that is kind of a high risk position and you're taking on a little bit too much leverage. But with a pre-construction property, you can typically have a deposit structure, which can amount from anywhere from 5 to 20% of a total deposit, but it's spread out over a long period of time. The builder gives you a timeline or schedule on which you can make those payments towards your deposit, and that'll all be credited towards your purchase on closing. And so a lot of pre-construction purchasers like this because they don't have to have 20% of the purchase price of a unit right away. They can accumulate that capital over the next 2 to 5 years while they wait for the property to be constructed and closed. I mentioned before how if you're comfortable with a downside scenario or a worst case scenario, then you're probably good to proceed with that type of investment. So let's look at what the worst case scenario might be for a pre-construction investment style. A builder could decide not to complete the project. A builder could go bankrupt in the meantime. Your unit might not appreciate in value as much as you anticipated in, which would mean that you would need to cover a shortfall between the appraised value and the value that you committed to pay for the property. And one of the biggest risk phenomena is that interest rates can be different when you have to close the unit than they are in present day. And so you might be forecasting, yeah, I know I can afford this unit based on X% interest rate, but what if I have to close this unit at X plus 2% interest rate for X plus 5% interest rate? Does that investment still make sense for you, or is it even viable for you to close on that property in that type of environment? As long as you've stress tested it and looked at what these worst case scenarios could be and you're comfortable with them, then you can probably proceed with investigating this as a investment type for you to get into real estate. We do have a lot of information available on the Valery website, so make sure that you ask the chatbot what the current projects and opportunities are in the pre-construction space and what the deposit structures look like for them. So I hope this gave you a good idea of whether or not it's the best decision for you personally to buy versus rent, or at least you have the information needed to start working on those calculations and making a decision for yourself. Next, we're going to cover your finances and personal finances in general and how those apply to making a mortgage application and getting a mortgage to purchase real estate in the future.